As a trader, you are certainly looking for a method to identify levels that cause price reversals and price reactions so that you can enter the market at appropriate points with the least stop loss. Pay attention to the image. All these reversals and price reactions are to levels that we will introduce to you in this video. In charts, we can generally consider two categories of levels: classic levels and price levels. In fact, price levels are within the classic levels and are areas of supply and demand in the market. Generally, the main areas that cause price reversals are supply and demand levels. These levels are the trading knots we also refer to as nags. In this channel, we will teach you the most up-to-date and advanced trading style. If you are interested in this category of content, subscribe to our channel and hit the bell icon. We'll see you after the intro and disclaimer. Welcome back, traders, so let's get started. Classic levels. By classic levels, we mean the supports and resistances on the chart that we draw from the existing valleys and peaks. In our style, pivots are these supports and resistances. I mentioned earlier that in this trading style, all levels on the chart have a time frame. Having the appropriate time frame allows us to examine the reaction to a level or the break of a level in that time frame, and this helps us find levels equivalent to each level and predict the price movement direction. We accurately identify the breaks. In our style, there are no fake outs. When a pivot forms and creates a support and resistance, there is a trading knot called FTC at a close distance from the level. When the price reaches this knot, we expect it to cause a price reversal. Therefore, we do not have a trade plan on classic levels, and we expect price reversals on FTC trading knots. When the price reaches classic levels, three scenarios happen. The price returns from the level, hunts it, or breaks the level. When the price surpasses the FTC and gets very close to the classic level, it either breaks the level, hunts it, and returns. After the classic level is broken, a trading knot called FTR is formed, and when the price returns towards the level, we will trade on this knot. Look at the images. The price returns from the FTC. The price hunts the level and returns, breaks the level, and in the price reversal, we can enter the trade at the FTR. If you enjoyed the video, please like it and subscribe to our channel. Dynamic levels. Dynamic levels, which are essentially trend lines, are another type of classic levels. Trend lines shift on the chart and are drawn by connecting valleys or peaks. After the break of each dynamic level, a trading knot called FTR is formed, where we expect a price reaction in the future. Price levels. Price levels are the same trading knots that are located near classic levels, and the price reaction in these areas is to them, not the classic level. Trading knots are visible in the trigger time frame. We define the range of the trading knot in the main time frame, then go to the trigger time frame, where the area with at least 3 consecutive candles stuck in place is our trading knot of interest. Sometimes the trading knot appears as a base, and in some cases, it is visible as a settlement pivot or pullback pivot in the trigger time frame. The most important trading knots are the knots resulting from the break of a level or price reversal. These knots are FTR and FTC, respectively. These two knots are essentially the main areas of price reversal. Of course, based on the length of the knots, we consider different names for the knots and specific areas for entry, which will improve risk to reward ratios. Other important trading knots include FLs, hidden gap of spike candles and long bars, hidden gap of long shadows, and the flag-based knot. FLs represent the range of the shadows of 2 long bars. Hidden gap of spike candles and long bars form a trading knot within the range of 50% of large-bodied candlesticks. Similarly, hidden gap of long shadows also form a trading knot within 50% of the candlestick's shadow. The flag-based knot is located within the range of 0.33 of the spike candle. In the following videos, we will fully teach all these trading knots. Pay attention to the image. With these points I mentioned, you can determine why the price reacted to these areas and find all the important points on the chart by looking. price can exhibit three behaviors towards trading knots. It can returns from the knots, move away from the knots, or engulf the knots. When the price moves away from a knot without any reaction, that knot transforms into a price flip, and the price tends to react to this level in the future. Price flip levels are important levels on a chart. Engulfing a knot means the price breaks out of the knot, and when the knot is engulfed, it means there are no more orders in that knot, and the price will move past it on the next occasion. All right, friends, this lesson has come to an end. The topic of trading knots requires a lot of practice and more training. We will present all these teachings step by step. Please comment your thoughts and share our video with your friends.